everybody. My name is Brad Muniz, and I'd like to welcome you to Sobel Insights. Sobel Insights is a series where we provide some brief information on various topics. Our goal is to keep these sessions to 15 minutes. At this point, we do not offer CPE. If you have any ideas for topics or speakers, please feel free to reach out to me. Our topic today is QCD, Qualified Charitable Distributions, and the presenter today, backed by popular demand, extreme popular demand, is Mary Ford. Mary, I've heard of these things. I've subtly seen these things. What are QCDs?
Well, Brad, a QCD is what we call a Qualified Charitable Distribution. It is a direct transfer from an IRA account to a charity, a qualified charity, as defined by the Internal Revenue Code. Taxpayers must be 70 and a half years old to make a QCD. And the maximum amount that you can make our distribution from your IRA to a charity that you can do annually is $100,000. And that transfer must be made by December 31st of the tax year. And it will count towards your annual required minimum distribution, your RMD. Now, I thought it would be very interesting for us to talk about this today because I'm finding that QCDs have become a very valuable tax planning tool for us ever since the Tax Cuts and Jobs Act of 2017 was enacted. Prior to TCJA, the most smartest strategy for making contributions to a charity was to contribute highly appreciated assets, charity. And that it's still a great tool. But, so what that is, just to give people a background, is if an individual contributes highly appreciated stock, that's generally what we use, we'll contribute stock that has a significant unrealized gain. So they're yeah, right. So, so they don't want to really, they're not ready to sell it because they don't want to pay tax on that unrealized gain. If that individual were to just transfer those shares directly to a charity, they would get a deduction for the fair market value of that stock on the date of the contribution. So that's a great benefit. So you get a step up in basis. So not only do you get a benefit for the tax deduction, you save the capital gains tax.
Right.
If you had sold the stock and then donated the tax, donated the cash, you would have to, that would significantly reduce your tax benefit.
Right, because then you get taxed on the gain, but you still get the deduction, but you get taxed on the gain.
Yeah.
And that increases your taxable income base too.
Right, exactly.
Yeah.
So then by, so that's still a great way to do it. However, when TCJA was enacted, that came with a very, that raised standard deduction significantly for individuals and eliminated or capped a lot of the popular deductions. So, and the miscellaneous itemized deductions went away. So we find that most retirees can't itemize their deductions anymore, but they're in a point in their life where they want to be charitable. They want to keep funding their favorite charities. So in order, so the QCD is a way for them to continue to get a benefit for contributing to their favorite charities, right? Because when you make a direct transfer from your IRA to a charity, you don't have to include that distribution in your income. So you get a deduction above the line. So it's not included in your adjusted gross income. It's a good benefit.
Are you still taking the deduction though too, if you do have other charitable contributions and above the standard deduction?
Well, there is in the CARES Act for 2020 and 2021, you are allowed an above line deduction for $600 in 2021.
Okay.
Sure.
This QCD doesn't count as eliminating your income and also taking a deduction too? Oh
no, it's that's right. Good point. No.
I tried.
I know. So you're taking this assumption is you're taking the standard deduction, so you would not get a benefit anyway because your standard would be higher. So,
right.
But this is, even if you are itemizing, it's still a good tool, which we'll talk about later, some of the other benefits of doing that.
Okay.
and above.
So
the
the one thing I
deduction.
noticed, because we do a lot of employee benefit plan audits, and in the footnotes, we say that you have to take a required minimum distribution at, used to be 70.5, now it's 72. Okay, that
Right.
changed last year. And you just said 70.5. Now, is that the old rule, or is it 72 now? Why would somebody want to take an RMD, required minimum distribution, before 72?
That's a good question. Well, 70.5, you're right, that was the old rule, but that continues to be the law for making a QCD. It's beneficial. I still advise taxpayers, if it is beneficial for them to continue to make a QCD if they're not required to take the RMD, because it has the effect of lowering your IRA base so that your future RMDs are now reduced.
Right.
And we're in this environment now where it looks like we're going to be having significant changes to the tax rates. You know, we've been hearing a lot of rumblings about that. You know, so it's a good thing to start reducing that base of your so your RMDs won't be as large in the future.
No, I didn't even think about that. I thought my questions that I'm going to be asking, I thought your responses are just going to all be, boom, it's tax, tax, tax. But you think about it, it's tax, but it's the fair value of your IRAs and your life expectancy. So that's very interesting. I hadn't put that in there. Now you mentioned, go ahead.
Oh, I'm sorry. I just wanted to, one other thing. And then if a taxpayer is, still wants to be charitable and because they have the standard deduction, they're not getting a benefit, this is the way they'll get a benefit for making those deduction too. The QCD allows them to.
No, a non-taxable, in essence, non-taxable distribution from your IRA.
Mm-hmm.
You're not getting the deduction for it. I did try, people. It's a non-taxable distribution, and you're supporting the charities that you prefer or that you'd like to do. Yeah. You said there are some other tax benefits, and I keep saying it's non-taxable. Are there other particular tax benefits?
Yeah, there's a few. So we have done some planning with taxpayers who are, turning 72 this year, where if they have, it has an effect of lower, maybe stopping you from moving into a higher tax bracket. So for example, we have Joey and Liz, right? They're taxpayers. Joey turns 72 this year. Say prior to this year, they're right on the cusp of moving to that next higher tax bracket. So taking his RMD, which is quite substantial, he would throw him into a higher tax bracket. We can work with them to determine, to shelter part of that RMD by making a direct transfer to a charity so that it lowers his taxable RMD amount so that he stays within those lower tax brackets.
Okay.
That's a benefit to him. Also because the QCD reduces your adjusted gross income that is used in determining, medical expenses, the benefit of taking the limitation for medical expenses. If you lower your RMD, you lower that medical expense limitation, which is 7.5% of your adjusted gross income. You get more benefit for your medical deductions. That's a good reason to do that. Right?
And miscellaneous, which really you don't get anymore, it's 2%. And also, I know people are going to say, come on, really? You're talking about this casualty losses, which is a big discussion right now with the two hurricanes that went through New Jersey. And they've been identified as FEMA, areas that they can take casualty losses, which I believe is 10% of AGI. So that'll help there too. 10% and also $100.
Yeah, where did that come from?
And that's just the smack to say, I don't like you, and here I don't like you more. Okay.
Yeah. Also, there's a couple other things too. I just want to follow up with, if you have a retiree, it also, if it reduces your adjusted gross income, it also potentially can limit the taxability of your Social Security benefits, right? So that's because if you have lower adjusted gross income, you're less of your Social Security would be taxable. Also, it has a way to reduce the surcharge on Medicare Part B premiums and Part D premiums, because if your adjusted gross income is over a certain threshold, you have to pay that surcharge on your Medicare premium.
Okay.
It can help reduce that. Finally, for those, as I said before, but if a taxpayer who is not able to get a tax deduction for contributing to their favorite charities, this enables them a way to take a distribution and not have to pay tax on it, therefore getting benefit. So it's a good thing.
Now, you said before $100,000 as to the limit. Is that's the overall limit that they can do annual? And then is that annually, lifetime? And is there a limitation as to the number you can do annually or in your lifetime?
No, there's no, yes, there is a limit. It's an annual limit of $100,000.
Annual, okay.
If you have multiple IRA accounts, say you have an inherited IRA account and an individual IRA account, maybe a SEP IRA, all those qualify for these distributions. You could take distributions from each one of those accounts, as long as the total of all of the distributions that are made do not exceed $100,000. And that $100,000 limitation is per individual, not per tax return. It's per individual.
Wow.
Yeah.
Okay. And you're saying IRA. Do you know if a 401k falls in here? Some people leave their money in a 401k. Do you know if that falls in there also?
It does not. You would have to roll your IRA over, your 401k over into an IRA.
Oh, that's interesting. That's very interesting. That's good to know. I'll tell our EVP people about that.
Yeah, that's a good question.
There's something else that's come up, and I actually mentioned it to somebody in audit. Why I mentioned this to somebody in audit, I have no idea, but I did. I had to see the glazed look. Making a donation or a distribution to donor advised funds. Is that allowed?
No, unfortunately, that's not allowed. It has to be, a charity itself, a 501c3 charity. You can't make a QCD from your IRA to a donor advised fund that you manage. And private operating foundations do not qualify, and private foundations don't qualify. So it has to be a charity itself, like your place of worship, your alma mater, something like that is.
So it can't be a charitable remainder trust. Look at me. Look at me.
Look at
Tell
you,
Angela,
Brad.
I just said that.
I will. Yeah, turning into.
And you say
my
can't be
little
charitable
tax
remainder trust? It can't be the trust, right?
Can't be the trust, no.
I got you in there too, so Angela's gonna be mad at both of us now for talking about trusts.
That's good. She's good, Angela.
Angela's great.
Yeah.
So I did have these, believe it or not, on a tax return, and this is not an access seminar, but I had a tough time putting in there and showing how it's reported to the IRS, because every time I put it in, it came in as a distribution. Putting aside the way access works in our office, how is this reported to the IRS? Or, I mean, is the 1099-R say it's a QCD? Do we have to put it on and then label it as a QCD?
No, yeah, that's a great question, because I worked on this with the taxpayer this year, and when he got to answer your question though, anything taken out of your IRA, your administrator will report it on a form 1099-R, and they'll show the total distribution and they'll show the total amount is taxable. So I got a call from the taxpayer. You told me this was not going to be taxable. Why does the 1099-R say it's taxable? Don't worry about that. Mr. Smith, when we file your tax return, we actually go in there and we check a little box in Access. And so that when your 1040 prints out, there's a little code on the line before the taxable amount of your IRA that says a QCD. And then the taxable amount is lower than what's reported on the 1099-R, which is fine as long as you have that little code in there that says it's a QCD, and that's why the taxable amount doesn't match up. The IRS still will do, I just finished an audit for an individual because this person is very charitable, and every year he donates the maximum amount via a QCD to his favorite charities from multiple IRA accounts. Okay, so the IRS said, okay, we need to understand this better. So he received a notice, which was fine. We had to go back to each of his IRAs, and they had to give us a copy of the check that was written directly from the IRA. So the check had to say, Vanguard wrote a check on behalf of Mr. Smith to this charity. And it had to be an account, his IRA account number. So we just showed the IRS all of this to show that it didn't come. In other words, the taxpayer can't take a distribution from their IRA, receive the cash, and then write the check. That doesn't work. It has to go directly from the IRA to the charity.
Almost like kind exchanges. You take that money, you taint it.
Yes.
So for all the and you just talked about that, so Mariana's gonna be mad. You just went in her area too, talking about 1031. For all nonprofits here, you should be identifying and looking to people for QCDs, but keep in mind, you may have to have certain language on your literature as it relates to this. But also you want to make sure if people are going to do a QCD, tell them, and you're not their tax advisor, but tell them that they should be instructing their IRA, their administrator, the trustee of their IRA to make the distribution directly to the nonprofit organization.
Right, that's the only way this works. Mm-hmm.
Right, okay, that's big. So we're just a little bit over time. I have one last question for you. This is going to be a hot potato. I want to see how you're going to answer this. All of a sudden, your mic's not going to work when I ask you this.
Mm-hmm.
What do you anticipate is going to happen with the QCDs under the Biden tax proposals?
Well, everything that we're reading now, they haven't really touched that. I think they haven't made any mention of affecting QCDs. There are some more. There's a lot of language in there. Some beneficial for retirees, some not so beneficial for the people who have IRA balances that are significant. Right, they're going to have to take that into income sooner. But if they do, this might be a good thing that can help them, right? By getting the tax give some of
so
them.
all of a sudden now we're supporting the tax proposals.
Yeah.
I'm in a quandary here. I don't want higher rates, but now if it's going to be beneficial, I'm not getting political. But
no,
right.
But no, this was good. I think this is a really great tool for retirees, and it's something that they should
and nonprofits. I think
and especially for nonprofits. Right?
Because I sit on a couple smaller boards and they were hurt because people, they're not getting that last minute deduction at the end of the year. Let me write that check for a few $100s, a few $1,000s. Let me write that check, to get the last minute deduction. All of a sudden, standard deduction's higher. No, this is definitely a way to help. I know nonprofits, you're not the tax advisor, but know what this is about, and you can try and talk to people and say, well, you can contribute from your IRA directly. So.
Right. Good.
Thank you very much for this information. I'm sure that people have more questions now. I know I do, okay, but I don't want to keep hitting you with more and more questions. So thank you very much, and I look forward to having you again in a future session. Definitely after the 15th of October.
That would be great. Thanks.
Great.
Thanks for having me.